Okay, very good morning. It's Thursday, 26th of October, so hope you are well, and I hope you are ready for what is one of the most important days in 2017 from a monetary policy perspective, because as you well know, today the ECB are about to embark on an unknown future, which is the very slow withdrawal of such an accommodative monetary stance we've had for many years post-financial crisis. So today's a really big day for the markets. We're going to talk about that a little bit in this briefing about what the markets are expecting from the ECB. We're also going to talk about that in a lot more detail later when those events, or ahead of those events, 12:45 for the announcement, and then also the accompanying press conference at 1:30. So we'll touch upon some of the main things that the market is looking at, but obviously there's quite a few other things that are ongoing as well that I quickly want to cover in this briefing, so I'll try and keep it as concise as possible. Okay, so looking at the charts then, firstly, let's just have a look at what happened, and unfortunately for me, I wasn't here yesterday afternoon. I had to lecture, and so looks like I missed all of the price action that happened yesterday afternoon. And looking at US equities in particular, so let's have a look at the S&P here, slightly longer dated. Quite a big sell-off that we're seeing really after the cash equity open. Having caught up with a few people and read a few things this morning, kind of the main catalyst that most people seem to be looking at is earnings season again. So just as earnings season helped just a few days ago in regards to some of the bigger components in the Dow. If you remember, we saw companies like Caterpillar in particular, 3M, so on, positive outlooks, exceeding expectations, increasing their forward-looking outlook. Now we had kind of the opposite. Granted, not as big stocks, but obviously as a cluster of companies. AMD. Now AMD does carry some significance. They're not actually a big company, but the actual chip making sector is relatively small, and AMD being one of the first chip makers to report, and then reporting negative news, means that sometimes the market just runs with it as that other chip makers will follow suit. So AMD, they were down 14%. I did see a good quote for Chipotle Mexican Grill giving the markets the run, was a headline I saw. They were down 15%. Boeing, which is obviously one of the bigger companies that reported yesterday, actually had good numbers, but they fell almost 3%. Despite beating forecasts, there was some attention towards a charge that they'd taken on their tanker program. And so earnings seems to have been a catalyst again. It did see the VIX index, something which I know some of you do look at, which has been tracking at its lowest level since the mid-90s, generally speaking, over recent months. That actually rose to its highest level since early September, so back to around 11.25 now in the VIX. But one of the other things, of course, as well, is the fact that we're at these elevated levels in equities. We've talked about this a lot, that if you think about volatility generally has been so shallow in the S&P in particular, and that at some point, if the market ranges are getting ever more narrow, then at some point you would imagine the market's going to spark to life. It's kind of the natural price reaction. The interesting thing here is that, well, for one, technically, when the S&P fell, it found a decent line of support at that low on the 19th. If you see, that line also goes back to relative support seen back at the beginning of the month. So the 6th, 9th, 10th, 11th, kind of around that period. Then we retested it on the 19th. That was when we had that momentary concern about Spain, a couple of negative European earnings at the time, and we dipped on that profit taking on the eventual bust through 23,000 in the Dow. The S&P dipped but then rallied aggressively, and here we are again retesting that level. So if we come back down at any point, that 25.42 type zone, if you like, is going to be important from a technical perspective. But lo and behold, as per the usual US mentality, I guess, it gets hit early, recovers. You know, this is a very interesting thing here, and I was talking to some of the new trainees yesterday. Was about American psychology, and if you look at the moves that we've had, Europe hit the market, US took it to record highs. US Open sells off. By the close, we've pretty much reversed and taken back the entire move. The interesting thing here is that this kind of buy the dip mentality of when equities get hit still seems to be fairly prevalent. Whether that will last is yet to be seen, but what we haven't seen yet is a bit of a downward move that's been sustained by the close. By that I mean that eventually this gets recovered by the time the closing bell is sounded. So if that does occur and we remain lower, then this could be more interesting for a bigger move or a shorter term correction that we could see in the equity market, particularly at these kind of elevated levels. The other thing that's quite interesting here is if you look at the size of the sell-off on Thursday, which if you remember last Thursday morning we were all kind of getting excited about the size of the sell-off. Well, yesterday's sell-off was even bigger. And again, if you were looking at patterns here, if this is a progressive nature of things, then certainly it could be the spell of things to come, and certainly today is going to be an interesting day because of the ECB and this unprecedented or uncharted territory that we're entering of taking away some of the stimulus, which has obviously been one of the main catalysts that has helped support these global financial markets, particularly equity prices. So yeah, must admit, I'm a little bit cheesed off. I missed the price movement yesterday. It seems to be the way that things go. Maybe I can just leave the desk and create some market volatility for you later on. But looking at a few other things before we get into the nuts and bolts of the ECB, there are a few things that are ongoing. So quickly, just to run through. Second point is the tax reform plans in the US. So, aside from the ECB, these are some other things that you should be aware of that are happening today specifically. The House of Representatives vote today on whether to adopt the 2018 budget that was passed in the Senate last week. If you remember, midweek last week, that was Thursday night going into Friday morning last week. That was when the Dow busted that previous high and went to fresh record highs at around 2:30 a.m. London time. Now that was because the Senate passed the 2018 resolution. Now the House of Representatives needs to vote for it today. So I would expect that probably to go through, and if passed, that will clear another hurdle before the finer tax plan details are released, and expectations for that are basically next week. So if this equity market is to remain obviously supported, then this tax plan is a crucial element for that to happen, i.e. if the House of Representatives vote it down and it doesn't pass, this starts to delay then the ability for Trump to start pushing forward on the tax reform, and hence then the negativity for any of these stock fluctuations to the downside might become more acute, because you're taking away then, you're starting to extend the timeline of implementation of the tax reform. So that's going to be important. That will be actually much later in the session. The other thing that you've got is Spain. If you remember the timings we were talking about at the beginning of the week with Spain and Catalonia and its independence, well, the Catalan president is due to address Parliament this afternoon. Now that's not actually going to commence until 4 p.m. London time. And so that's something we're going to be looking out for, because then the federal government will be speaking and giving their decisions on Friday, which then, if the government, Rajoy, follows through on what he was saying last weekend, means that then they will take over the region of Catalonia as of Monday. So Spain might come back into the fold by, I would say, this time tomorrow. And obviously we'll be dealing with the aftermath of what the ECB have said. The final thing is Fed chair and the kind of race to who becomes the replacement for Yellen. I think one of the most disconcerting things I've read this morning is Trump almost flirting with Janet Yellen, saying how fabulous she is slightly disturbing. But what he's actually saying here is that Yellen still remains an actual credible candidate and definitely should not be discounted at this point. He continues to talk up Yellen, if anything, saying that Mrs. Yellen might be worth keeping. He said, "I would certainly think about that." He added, "A decision will come in the next very short period of time." Make of that, in terms of a timeline, what you will, but he's been saying this for a while. there is no definitive timeline of when he is going to unveil that. The one thing he did say last night, though, or Bloomberg were reporting that people briefed with the president have basically said that Gary Cohn is not going to get the appointment. We kind of knew that already. That's really no surprise at all, because if he'd fallen out of favour a few months ago with some of the domestic situation ongoing in the US, what Trump is saying, actually he's being a relatively measured politician. He is saying, I'm not going to pick Gary Cohn because I want him to focus on tax reform efforts. So that's one person removed, so to speak. So definitely this Fed situation, we saw that yesterday with some movement in yields on the back of what was the previous night where John Taylor was rumoured to be favoured in the Wall Street Journal. So that's definitely an ongoing story you need to be aware of. So tax reform, the House having the vote later today, Spain, Catalan president delivering a speech later this afternoon, and then you've got just be vigilant for anything on the Fed chair situation. Okay, so that kind of wraps up that side of things. Looking at a couple of earnings reports, because there has been a cluster this morning. I'm going to run through the headlines. I'm not going to bore you with the details. But again, this is something I was speaking to the guys who are literally just joined our career program. And this was about if you're going to trade the DAX, for instance. I'm just checking, I can see the live prices here. Fortunately, no one's traded the DAX because I was going to call them out live and ask them to tell me the specific earnings details for Bayer, being the second largest company in Germany. So you're lucky you've all got away with that. But the point being is that if you're going to trade an index, you really should be aware of when the largest companies within that index are reporting. So someone like Siemens or Bayer, for example, these are the largest companies in Germany and have a strong degree to influence that index at the market open. So if you're looking at the market purely technically, you might get caught offside pretty quickly if you're not aware or fully informed of all the information that's come out. And these earnings are telegraphed, they're scheduled, and they come out pre-market open, so there's really no excuse not to be up to speed before the market, or certainly the cash market open. But in summary, Bayer, their sales decline as consumer healthcare drags. Their shares opened down about 1.4%. Deutsche Bank, trading slumps 30% as their chief revamp sputters. So basically they're having more issues. Deutsche Bank, I think, having issues is probably the least surprising of all of the major global banks. Their shares down about 1.5%. Munich Re expects profits to take powerful blow from hurricanes. Obviously this was if you remember, when Hurricane Harvey, Irma, Nate, all these situations were occurring in the US, it was the insurance sector which got hit the hardest. Why? Because they have to pay out large sums then on insurance payouts. This is the same. Munich Re has exposure there, so their profits impacted in that respect. On our own shores, Barclays, their profits rise 40%. Despite a hard hit to their trading revenues, so they've had a jump in quarterly profits. Lower customer redress costs in its UK bank offset a decline in bond and currency trading revenues at its investment bank. And then one of the largest companies in Switzerland, if there is anyone who looks at the SMI index, ABB reports accelerated earnings in Q3. And Jimmy, thank you in the chat room, just updating me on Bayer's last share price print. They're down 2.6% at the moment. So definitely you should be aware of these earnings. Again, the prudent practice would be to prepare ahead of time by looking on those Bloomberg earnings calendars I've shown you before, just to be sure that you don't get caught the wrong side of a price move in an index early trade. Okay, let's get down then to the ECB, and I'll try and keep this as simple as possible. We'll go through it again, possibly in more detail later. But why is today so important, and why is it potentially going to be very market moving? Well, I saw an article from a chap called Mohammed El Arian, who used to work at the largest bond fund in the world, PIMCO. I think he's now still chief economist at Allianz. He's a very respected market commentator, and I think he summed it up nicely in one kind of sentence of why today is going to be volatile, whatever the situation. because basically the bank, i.e. the ECB, need to strike a delicate balance between a measured exit and a retention of policy flexibility. It's almost like, if you think about the way in which, equities is probably the most case in point of being supported by monetary policy post-financial crisis, but this has been a phenomenal rise that we've had really over the past decade. The implementation of unconventional measures, not just the ECB, but worldwide from the global central banks. And for the first time now from the ECB, it's going to be about taking some of that away. And this is what makes many people who are already on lots of different metrics questioning, are we at the top at the moment, is only going to help fuel that argument. A couple of other things that he highlights that I think are definitely interesting from a broader perspective before we get into the nitty-gritty of the announcement. If you think about it, compared to the US, the Eurozone is less advanced in its economic recovery from both a cyclical perspective and in terms of developing structural roots for long-term inclusive growth. One of the main things here is, if you think about economically and financially, you're looking at 19 member countries, all of which are quite different. We talk a lot about Club Med, or the north and south divide of Europe. You've kind of got Germany on one side, then you've got Greece right down in the other side. Unlike the Fed, which can manage its federal regions, if you like, under one US umbrella, with Europe, you're trying to manage with one policy completely different social, economic, financial situations. This is what makes it incredibly difficult from an ECB's perspective. And certainly from a political context, much more complex. If you think about this hawk-dove spectrum, obviously Germany have a completely different request of what they want from monetary policy from someone like Ireland or Portugal, for example. So it just makes this all the more difficult process for the ECB. You can imagine what their policy meetings must be like for today's event, and the arguments that are ongoing between, looking at it in black and white terms, the Germans, the Austrians, the Dutch kind of pushing for, let's start moving QE now and being quite aggressive. The economy is recovering. We've seen that with recent economic data. And then you've got the other side of the table arguing the complete opposite. Slow and steady and cautious, if anything. So looking at a couple of charts here, this is a Bloomberg article that I've sent out to you guys. Here's the timeline of what we're looking at when it comes to the ECB. So here we are today. They're going to make the announcement on QE future. Why are they doing it now? Because the program is due to end in the next few months. And so what they do is they're looking to communicate, be transparent to the market in order to create a sense of stability and certainty for the investing community. So forward planning is definitely important in terms of communication tactic. So today is critical, not that anything will change, but because then the market is priced on the future expectation that change will come in January. So what they're going to say today from a consensus expectation is that this 60 billion of euros that they purchase every month is going to go to 30 billion. But that's not going to begin until January of 2018 officially. Then going further forward, they're going to extend the program by 9 months. Now there has been a slight shift in market expectations. Talk about, I'd say 4-6 weeks ago, was more about 6 months. It seems now that they've gone to 9 months, so a slightly deeper cut, but over a longer period. So again, very incremental winding down of this program in terms of its firepower. So net purchases will end. Forward guidance changes then. That would be September of 2018, so almost this time next year. We're not looking at an actual interest rate hike in Europe, i.e. if you think about their deposit rate, which is currently negative 0.4%, that not going up until Q1 of 2019. So if you think about this kind of monetary cycle, think about the Fed. The Fed hiked in December 2015, December 2016, and they've hiked 2 times already this year, and they're going to hike in December. So that the Fed, by the end of this year, if they deliver December hike, would have done 5 already in their normalization process, whereas the ECB won't look to do their first until Q1 of 2019. So the Fed are way ahead in terms of they're already tightening the balance sheet, having finished their actual kind of QE purchases a long time ago. So this is the timeline and the context. If we scroll further down, a few other things to have a look at. Now, I've got some details from an FT article which was outlining some very key points here, and this is here. So the point being is that the ECB now holds well in excess of 2 trillion euros of bonds. So through this mammoth amount of bond buying, they're accumulating huge amounts of debt, essentially. The market expectation is that maturing debt will be reinvested and that the process should provide considerable support even as the program is expected to tail off. So if you think about a bond has a maturity date of which at the time of expiration the principal payment is made, and therefore then that money is reinvested, and so the program is almost rolling, if you like. In the US, what we're going through is a case of quantitative tightening. So actually, very slowly, the Fed are intending to not reinvest the proceeds, whereas the ECB are expected to do so. Analysts at UBS, they estimate that total reinvestments of maturing debt will amount to 100 billion in 2018, 130 billion in 2019. This represents a significant level of continued participation in bond markets on top of, don't forget, this extension and the 30 billion in QE does equate to 270 billion euros that would arise from a 9-month extension at 30 billion a month. So just think about it, with the proceeds being reinvested from the existing program, that's 230 billion plus the 270 billion from this extension. We are still doing QE of half a trillion euros here. Let's not get around the fact that this is a very gradual process that we're going through in terms of this removal or tapering process. What else that investors will keep an eye on, and I just want to quickly mention this to give you an idea and context of other things. This is when it starts to get a little bit complicated, and why today's event unfortunately isn't as binary as just 9-month 30 billion, because the ECB buys lots of different types of bonds. So the ECB owns 120 billion euros of corporate bonds, nearly 250 billion of covered bonds, 25 billion of asset-backed securities, and 1.8 trillion of sovereign debt. If purchases are cut in half, then one question is, how precisely is the reduction distributed across asset classes? So where is it that these different bonds they're going to choose to start reducing the purchase power? And that will be key and might influence certain specific areas more than others. Investors also brace for a potential loosening of the ECB's own rules regarding the types of bonds it can buy. If you think about someone like Germany, for example, they're getting close to a point where they're running out of bonds that they can buy. And if that is the case, then actually it's a rule change around the purchases that needs to also come about. The final thing is, and this is a point I touched upon earlier, many point to low levels of volatility across markets, suggesting that even the slightest removal of policy stimulus could create then a real flashpoint of market volatility. Because again, this has not happened before in terms of Europe. So definitely it's going to be very interesting. So let's get down to how the market might react, and this is quite an interesting graphic to give you a perspective. This is neutral, dovish, hawkish. So if it was dovish, i.e. they're cutting the amount 60 billion by a smaller margin, so i.e. just 20 billion to 40, and they extend it for a longer time frame, 12 months instead of 9. Neutral is as what we've discussed. Hawkish, they get more aggressive with the cutting more sharply the amount of bonds they purchase, so only purchasing a smaller amount of 20 billion, and they do it over a smaller time frame of 6 months. This here is an average median consensus of where euro-dollar would go under each scenario, to give you a bit of an idea. We are trading euro-dollar, as I speak, 118.50 in the futures. So if it's neutral, essentially we will remain within this point range, 118. So potentially a bit of downside on an average basis. If they go more aggressive, you might see a 120 move, more dovish, a 116. So that might help give it a bit of context for you. In terms of how I guess equities would react in this instance, the way I would look at it is it's almost an inverse relationship, i.e. dovish, European equities rally. Obviously a much more slower tapering would be then akin to being more dovish, more supportive of equity markets that's helped lift those valuations in recent times. So the opposite would happen. If they then were hawkish, equities would come under pressure. Neutral, same point as with the euro, roughly within the kind of band that we've been in. So some interesting things to look at. Obviously this is one of this final kind of one I'll share with you is the final headache, I guess, that the ECB has. Similar case as to the Bank of England, but for a very different reason. For them it's getting out of control. For the Fed, like the ECB, it's not where they would ideally want it. And this is, the ECB needs to be careful as inflation does remain below its target. So it hasn't quite started to pick up, but because of economic growth, and as we've seen with PMIs recently, even this week, optimism about the forward-looking future, then overall they're expecting that demand should start to pick up in the future. I'll leave you with some final comments from Deutsche Bank of what they're saying, because they do outline another couple of interesting things. They are going for the consensus, i.e. 30 billion in 9 months, but they do point out two other key things. Their rates strategists think an explicit mention of gross purchases from the ECB could be quite hawkish, as it would acknowledge the reinvestment issue that would naturally keep policy looser if they recycled all proceeds. So that's kind of that idea that we were talking about. Everything that comes due, they just reinvest. If they start to tweak that, that could be more hawkish. Another hawkish signal could be a mention of an explicit end date for purchases. If you think about it, they're going to extend by 9 months. But when they say they're going to extend by 9 months, if they say we're only going to extend by 9 months and then that's it, that would be extremely hawkish. And I'd expect the euro to rally under that condition, because the ECB have been very careful to communicate in their statements that not that it's completely open-ended forever, but that if necessary, under certain conditions, we can look to continue the program further beyond the current end date of September of 2018. So the point being, there's a lot that's going to happen this afternoon. From an execution point of view, you're going to get the statement, so the rate decision, which will be accompanied by the QE announcement, will come at 12:45. So usually 12:45 is a bit of a non-event, but 12:45 is key. Then Draghi's going to look to explain the decision making at 1:30. So you've got two parts to trade. Now, just before I wrap things up, I've just seen a couple of guys in a live chat room talking about cable just while I've been delivering this briefing. So cable a little heavy. Brexit talk. There's been a few things, but nothing really groundbreaking. The same situation, still at loggerheads almost domestically, even without even talking to Europe. But yesterday's low, evening 132.46, and afternoon low at the same level. We're close to testing that at the moment. Now, if you remember, this is a pretty big level for the currency. I was looking at this yesterday, and this was the October significance of the 132.48.50 level, which is basically what's providing a little bit of support here this morning after the move higher. You can see that on these various circles that I've highlighted of previous support and resistance. When we broke that yesterday, it really saw an acceleration in the price movement to its respective R2. It came back to that level twice before bouncing back to R2, and here we are back to that level again. So definitely worth just keeping an eye on cable. But overall, I would say, unless something very clear presents itself, the more prudent strategy, because the day is going to be defined by what the ECB do later. So keep that in mind. Don't get too carried away in the morning, because you want to have plenty of ammunition for later. Other than the ECB, just a quick look at the calendar to finish things off. The morning, really, there's not a lot going on. Then in the afternoon, you do have US trade balance, wholesale inventories, jobless claims. But to be quite frank, you can pretty much just put that to the side and focus on the ECB, because that's even what the US will be looking at with most attention as well. From an earnings point of view, just so you're aware, most of these won't come out until after market. But it's Tech Day, Alphabet, so Google, Amazon, Microsoft, Intel, Twitter. These will all be interesting really for aftermarket if you're trading US futures. Okay guys, that's it. Have a good day. I'll be back on later ahead of 12:45 to go through the ECB once more, and we'll look a little bit more about the reactions and levels. Have a good day.